Welcome back. We're going to continue from the previous videos. So in this video, we're going to cover share buybacks, right? So this is when the company buys the shares that it has issued, right? So why will the company do this? Buy back its shares. The company will do this in order to return value to shareholders. Like instead of declaring a dividend, the company can return value through share buybacks, right? In order to improve its financial ratios so that it can attract investors. The ratios like your earnings per share, price earnings, your return on asset, and return on equity, right? These ones, we're going to cover them later in this chapter. Also to decrease dilution of shares due to employee share schemes. This is just advanced accounting. So that's for you to know. The company does buy back shares in order to decrease the dilutions of shares due to employee share schemes, right? Then what happens when the company buys back the shares, right? It means the shares are being bought back. The share capital, which is also known as the ordinary share capital, will be reduced by the book value of the shares bought back, right? Remember, share capital, this is the number of shares that are being issued to the shareholders. So if now they're being bought back, it means this number is going to reduce, right? Then the other thing is the share buyback, obviously, because of is being to return value to the shareholders is through cash being paid. It's not share buyback via debt along those lines. No. So it means your bank balance will reduce by the amount that you're going to pay to shareholders, right? Then it happens sometimes that most of the times that the price that is paid is more than the book value of the share price, then that difference between your price, the price that is being paid for that share buyback and the book value of the share price of the share, and that difference is going to go to retained earnings. Why? Because of the company has given more cash compared to the book value of the share, means retaining some of its value to the shareholders. And as we see in that any transaction that relates to shareholders, it goes through retained earnings, right? Like your dividends, etc. But we'll see much when we are going to do example next. So example, if company A has like 2 million shares issued and the book value as at 1 January 2021 of the shares is 6 million, on 31 March 2021, the company bought back 300 shares at 450. What journal entries will be processed to account for this transaction for the financial year ended 31 December 2021, right? The solution, first thing, you need to determine the book value of the share before the share buyback, right? We are told that by the 1st of January, the book value of the shares that are being issued is 6 million. And there are 2 million shares that are being issued. Then it means the book value per share is 3 rand, right? We then determine how much was given more than the book value to shareholders. So they say they bought the shares, back at 450, whereas as we determine the book value is 350. That means 150 is given more than the book value, but we'll see in the next slide. Book value before share buyback 6 million divided by 200. Sorry for typo there. Oh yeah, it's fine. I think it was just the typing. 2 million shares, then it's going to be 3 rand per share. Then the amount paid to shareholders above book value, we say they buy the shares back at 450. The book value as determined above is 3 rand. Then means they've given more by 101 rand 50, right? That means your share buyback, which is the ordinary share capital, is going to be reduced by 900,000, right? Which is 300,000 shares times 3 rand, the book value, right? Then the bank will be reduced by 1.350, right? Which is 300,000 times 450 because of they've paid 450 for the shares that are being bought back, right? Then your retained earnings is going to be reduced by 450,000. Why? Because 150 times 300,000. So what you can see here is if there's a share buyback, the company is going to buy back those shares above the their book value. Why not to motivate the shareholders? Because why should you, as a shareholder, sell your shares that are worth less? So it's better for you to sell them at a higher price. So in order to motivate the shareholders to sell those shares back to the company pays more money compared to the book value, right? Then the general entity that is going to be processed, as we say, the ordinary share capital is going to be reduced by 900,000 because of 900,000 was being paid in relation to those shares. Then we'll have a share buyback of 450 because of 450,000 of the total 1350. It was paid to the shareholders, right? But only the book value is going to be reduced, the ordinary share capital. Then the difference is what we call share buyback account. That is going to be taken to retained earnings, right? That's where it's happening. Retained earnings is going to be reduced by 450. Then that share buyback, because here it was a debit, here is going to be cancelled. Then it means there's no such account that will be a share buyback account. We'll see more when we go to impact on the financial statements, right? The general ledger, ordinary share capital. Remember, on the 1 January, opening balance was like 6 million, right? Then we bought back the shares, meaning we reduced the share by the ordinary share capital by 900,000 book value. Then it means now the value of your ordinary share capital is 5.1 million. So when the users of financial statements are looking at financial statement, they'll know that okay, the shares, the value of the shares that were being used was like 6 million, but now something happened. Now they are reduced to 5.1 million. It means 900 for 900 shares for a value of 900,000 were bought back, right? Then your share buyback account, it reduced your bank account. Then it means it's debit share buyback with a bank account of 450. Then that share buyback, because it is not a balance sheet account, it's going to be taken to retain any same concept as dividends, right? Because it relates to shareholders. Any transaction that relates to shareholders, it goes to retain earnings, right? Then on the balance sheet, we expect to see your ordinary share capital of 5.1. It was 6 million, but 900,000 value of shares were bought back. Then it means it's 5.1 that is being left, right? Then your retained earnings. Remember, retained earnings, your balance from last year. For now, we just ignore. Net profit after tax, we just ignore. Then you have this share buyback of 450. That's where you can see. Then you have dividends. Also, for the purpose of this example, just ignore. Right? Then we can do a recap. We've learned about the accounting cycle for companies that first thing, the journal is being processed. Then once the journal is being processed, it goes to your general ledger. From your general ledger on the accounting system, a trial balance can be drawn. Once the trial balance can be drawn, then it means financial statements can be prepared. We've learned about income taxes. In income taxes, we learned that it's 28% of profit before tax for the purpose of the syllabus, but there are other complexity which outline how the 28% is being calculated. We've learned about the provisional tax payments, which reduces your burden to pay the higher income tax at the point in time. We've learned about interest-bearing loans. The most important thing is that interest increase your loan account, and your loan payment is not only to reduce your loan principal or the amount that was obtained initially, but is a combination of your capital amount and your interest. Then just now we learned about the share buybacks and how the share buybacks are being accounted for, why the share buybacks are there, and then the impact of a share buyback where the company is paying more than its book value. That difference, the price that was being paid to the shareholder to buy that share back, if it's greater than the book value, the difference is taken to retain earnings, right? Then in the next video, we're going to do past exam papers to test ourselves if we did understand all the concepts that you've done so far. Then the question paper that we're going to do is going to be your 2019 November exam, Department of Basic Education. We're going to do question 4, financial accounting, question 4.1, 4.2, 4.2.3, right? Then we covered that one in the next video. Thank you.